On behalf of the Entrepreneurship Development Cell of St. Xavier's College, Kolkata, it is with great pleasure that I extend a warm welcome to each and every one of you. It is with the utmost honor, privilege, and gratitude that I introduce you to a visionary leader, Mr. Neil Borate, an inspiring individual who is a deputy editor at Mint, an award winning business publication from India, which is held in high esteem by the country's business leaders, founders, and policymakers. Published by HT Group, one of India's largest media and entertainment conglomerates, Mint started his journey with an exclusive collaboration with the Wall Street Journal and was also India's first newspaper to be published in the Berliner format. From a work front, Mr. Borate heads the personal finance team at Mint, so has degrees in Bachelor of Laws from Symbiosis International University and Bachelor of Science from University of Birmingham. He has done his diploma in investments and securities from University of Birmingham as well. We are beyond delighted to have you join us, sir, and relay your experience, expertise, and journey to curious young minds. We are extremely thankful to you for taking time out of your busy schedule for a session with us. On behalf of everyone at EDC, I extend my best wishes to all participants for an insightful learning experience during this session. Now, I would like to hand over the virtual podium to you. So,
Thank you so much, Harsh. It's a privilege to be here. My surname is a little confusing to a lot of people who are not from here, so it's a Borate. But thank you very much. What I want to ask everyone in the audience is to ask questions at any point of time. Don't wait for the end. Let's have a conversation. And with that, I think we can begin. So I'll quickly start sharing my screen. Just give me a second. All right, so let's begin with the history, right? Where are we in India's growth context? I would say we're at a fantastic time, especially for you guys who are starting out with your careers, with your investment journeys as well. You know, when I was finishing my college, things were not so bright. We were coming out of the 2008 recession. India itself was not exactly growing as fast as it is now. Our stock market returns were not as good as they are now. And so there is a kind of lottery of birth, and you guys have won it. So first of all, you know, you have to be thankful and really appreciate that. So let me give you some figures around this. Basically, you can divide India's GDP growth into these two, rough periods. Actually, if you go back to 1947, 48, the GDP growth rate would be 3 to 4%, but I've gone back as far as the World Bank database permits me to. And then the second phase begins in this 2000 to 2022 period. Incidentally, if you think of India's most famous investor, Rakesh Jhunjhunwala, some of the big stocks that he bought and that built his fortunes, he bought in the 2002-2003 period, the start of this fantastic 20 years. And he started off with, they say 500 rupees. It's hard to verify this, but it would be something around this figure. And when he passed away, his listed stock portfolio was worth 35,000 crores, just his listed stocks. So that's the kind of wealth creation that has happened. And by no means is it over, right? In our lifetimes, we're going to see an enormous amount of it. And not just in the terms of the stock market growing, but all around us, we're seeing this country transform itself in a way that you would have never imagined. If you can just have a chat with your parents, have a chat with your grandparents of what it was like 10, 20, 30 years ago. Totally, almost a different country. And it's palpable. So in my own life, I live in Pune, and I would have never imagined that there would be a metro which is at my doorstep, a modern, sleek metro that connects me to a lot of the rest of the city, and it's only just being built out. I know that Kolkata has a very old one. It's been there for a long time, long before the other cities began building it. but the rest of India is catching up in a sense, and not just metros. That's one example. We have new trains. We have Vande Bharat trains that are extremely good, world class. So in so many ways, we're seeing it happen. We're seeing it unfold all around us. Um, by contrast, much of the developed world is not growing as fast. It's So China, this is a bit of an older figure. China has slowed down massively. As far as Europe and US goes, 2%, 3% is not great. So as I said before, we have in a sense won the lottery of birth. We're extremely lucky to be alive at this time in our country's history. Now, again, if you were to have a chat with your parents about how they invested, these are the kind of answers that you would get. Real estate and gold were dominant. And I've had this chat with my parents. My parents are doctors, and they put most of their savings into real estate. That's all they knew. And in fact, it's quite interesting because at that point, there was something called the Bombay Tenancy Act. So my grandfather had let out some flats to tenants, and because of that law, it was impossible to evict them. So my parents basically spent most of their working life having to deal with the tenants and eventually, buying back their own flats that my grandfather had bought. So we come with that history, with that baggage. In those decades, stock market also really didn't go anywhere. And why? Because of these issues. Brokerage was extremely high. It was all physical paper-based trading. You wouldn't actually know what price your broker has bought and sold. It's unimaginable now, right? Today we have computer screens. We know, we can see it in microseconds what price the stock is being transacted at. Back then you'd have to call your broker, and then they would transact. It would not be visible to you. Sometimes there were malpractices. Brokerage itself was extremely high. Signature mismatches because you had to, to take delivery, to pay money that you have to sign. Sometimes those mismatches could create trouble, could create delays in getting your shares. When it comes to mutual funds, they had something called entry load. We probably haven't even heard of this term. A lot of people here. This is a charge that you had to pay just for investing in a mutual fund. Then there was upfront commissions until very recently, until 2018. Distributors, bank RMs, they could charge upfront commissions. And in general, expense ratios were higher in mutual funds. It was a very clunky, inefficient capital market, and a lot of that has changed. It's been cleaned up, and SEBI has been at the forefront of that cleanup. So the system that you guys will enter into, is vastly better than the one that preceded it. All right, so I've given you a bit of history of my family, since my parents had to invest in real estate. Very interested to hear anybody else who wants to share about their family. Please unmute yourself and talk, or you can put it in the comments and the chats. And if not, just ask your parents, ask them how they invested their money, right? When they passed out of college, what did they do? So let's look at the stock market as a whole. What kind of returns it has given, what kind of returns it should give, what we should expect from it. So the most scientific way of approaching this question is to look at something called rolling returns. Now, what are rolling returns? So let's say that you were to ask yourself, what return has the Nifty given in the past 1 year, right? You pick any random day, let's say you pick today. It might just be the case that a year ago, the Nifty was in some kind of trough. It had gone through some kind of correction. So today's 1 year return looks extremely good. But you cannot extrapolate that return into assuming that this is the return that will persist, that this is what you will get in the next year. And the same applies to even longer term returns. Even if you look back into the past 3 years or 5 years, it could be just a random fluke that the returns look so good. How do you correct for this fluke? So you use something called rolling returns, where you take one period of time, let's say 1st Jan of 2020 to 1st Jan of 2021. Then you take the 2nd Jan of 2020 and the 2nd Jan 2021. So you take these rolling periods, you move ahead by 1 day or 1 week or 1 month, and then you take the average of all these rolling periods. You do this because, like I said, you don't want to be just looking back from a random fluke point of time. You want it to be scientific. You want to know what you would have gotten had you picked any point of time, really. So, and this is the measure that will tell you, give you a more robust answer. So, if you look at the data that I've presented here, the average return of the Nifty, the 5-year, okay, and this is, by the way, it's a 5-year rolling return, because equity is for the long term. I repeat, equity is for the long term. A lot of the financial system will try to push you into short-term trading, will try to get you hooked on to futures and options, F&O. It's basically a adrenaline shot, because if you make lakhs or crores of money within days, then you think you're the king of the world. But there is a much stronger basis to long-term investing. Short-term investing is very close to gambling when it's practiced in certain ways. Long-term investing is about buying businesses that will last, because businesses do not make their profits overnight. Businesses and companies take quarters and years to build up. And that is why you need to be with companies as an investor for long periods of time. You have to stay the course. So the average return, the average 5-year rolling return for the Nifty, and I've used the Nifty ETF as a proxy here. So Nippon India ETF Nifty piece is just a way of getting the Nifty total return. If you include the dividends, this ETF captures that. So that's been 11.73%, right? Which is great. Now, if you look at, for example, the minimum return, right, the minimum 5-year return, it's just been minus 1.22%. If you were to take shorter periods of time, like if you were to ask what is the worst return I would have got if I just held for 1 year, this figure would be a lot lower. This minus 1.22 would be, I can't remember exactly, but it would be less. It would be minus 10, minus 15. It would be much more volatile. But what happens in the long term is these things even out. The stock market resumes its growth trajectory. Pay attention to the distribution of returns as well. So if you look at this, 10 to 20% returns have come 61% of the time. The majority of the time, this has been the return range. More than 20 also they've come, but of course a small number of times. And again, if you go to negative, it's just less than 1% that it's been negative. Again, the power of long-term investing, the power of compounding. And this goes back to what I said, we live at a lucky time. The earlier you start investing, the more you're able to stay invested and make use of this tremendous compounding power of the market. Now, the question is, as they say in mutual fund advertisements, that past returns cannot be an indicator of future. So if that is true, then how can this be true? So the answer is more nuanced. The answer is that past returns, especially when you apply robust scientific measures like rolling returns, give you some idea of what might happen if you hold for the long term. It's not a guarantee. It's not a sure thing. Nothing in life is sure, right? It's just the best, most scientific system we have. Another way of estimating future returns, especially for the market as a whole, is to just look at the Nifty. Is to just look at the nominal GDP growth rate. So what is the nominal GDP growth rate? Nominal GDP growth rate of India is the real GDP growth rate plus the inflation rate. And in the long term, the stock market tends to come close to the nominal GDP growth rate. So if we were to estimate that GDP growth in India in the long term, the next 10, 20, 30 years, will be in the order of 5%. And if we were to assume that inflation will also be 5%, then you just add up 5 and 5 and say that my estimation is that the stock market will give 10% CAGR, compounded growth, in the long term. These estimates are, of course, subject to change, but not much tends to affect the long-term trajectory. So if you think of the inflation rate I've taken 5%, that's very much within the RBI's tolerance band of 4 to 6%. Same for GDP growth. India on most years has given more than 5% GDP growth. Actually, 5% is extremely conservative, right? And the 10% figure I've arrived at is also extremely conservative. in many years you will find that we've actually exceeded this figure both in GDP growth and in stock market returns. Okay, let me show you guys another way of looking at the same thing, which is the probability of exceeding certain thresholds. So this, by the way, is Nifty TRI. TRI means total return index. It means that we are including dividends in this calculation. So as you can see, the probability of making an 8% or greater return, it increases the longer you hold your investment. Same for 10 or more percent, same for 12 or more percent. Again, it reinforces the message that buying and holding for long periods of time has given extremely good returns. A lot of you folks here are quite young. You might have never invested in the market. You might not have the money to do so. But if you are able to persuade your parents to give you a small amount of money, because remember, equity investing is risky. You guys are young. You might very easily lose all of it. So just take a small amount of money and try some of this stuff. Because in a few years, you'll be working, you'll be getting a salary, and suddenly you will have to make all of these decisions. Where do I invest? Where do I save? I want to buy a house. How do I save for it? I need to pay tax. How do I file my taxes? I need to a pension when I retire. How do I get that pension? Suddenly, hundreds of decisions are thrown at you, and there's no preparation. There's nobody to tell you how to go about this. So it's always good to start early. Just take a very small amount of money and see what investing feels like. There's also, by the way, a tax advantage because many of you will not be either in the taxable bracket at all, or if you are, you'll be in the very small, maybe the 10% bracket or something. So it'll be actually tax efficient for your parents, for your family to for those gains to come to you rather than to your parents. So by all means, please start early. Even if you don't have money, borrow some money from your parents. So let's talk about SIPs. I'm sure most of you have heard this term. I'll still nonetheless quickly explain it. An SIP, or a systematic investment plan, is a plan in which you invest a set amount every month. For those of you who start working in corporate jobs, get a monthly salary, it is very, very attuned to your monthly income. You take some part of it and you invest. And it utilizes the tremendous compounding power of equity, right? So if you were to just start an SIP of 50,000 rupees a month, and if you were to assume that it grows at 12% CAGR, compounded growth rate, over 10 years, you have a 1 crore corpus. And by the way, if you do intend to buy a house, you can reinvest this money into buying a house, and you don't get taxed. So long-term capital gains tax has an exemption if you deploy the money into buying a house. Now, of course, a lot of you might think that 10 years is a long time. How can I wait that long, etc., etc. This is a conservative example, right? You might make more than this, or you might buy a slightly cheaper house, or you might take a loan for some of that amount. But what I want to say through this slide is just how powerful investing through an SIP is in an equity mutual fund, and how it can help you achieve your early goals in life. By the way, do stop me at any point of time. If you find something interesting, just unmute yourself and ask. If there's an audience question, please type it in YouTube, and the cell members will ask me what the question is. So yeah, so just ask. Okay, so I talked to a couple of you guys before I started, and I asked, do you invest in mutual funds or stocks? And I mostly got stocks as the answer. And yes, if you do pick your stocks right, then you can outperform a mutual fund. But remember that the odds are stacked against you. Mutual fund is a professional fund manager, usually the best of the brightest from an IIT or an IIM. They have enormous computing power. They have analysts at their disposal. They have experience to draw from. They have data. They have tons of things which you sitting at home cannot hope to compete against. And that is why mutual funds are such a powerful instrument. They're kind of boring instrument for a lot of young folks because they have a bunch of restrictions. So mutual fund can't invest more than 10% of its portfolio in a single stock. But those restrictions are there for a reason. They're there to protect you. They're there to protect your money when a downturn happens. It's really difficult to imagine a downturn because there's been such a long bull market now, ever since the pandemic and even before. But trust me, they happen. I've lived through them. You need to protect some of your money. Apart from the safety aspect and the advantage that mutual fund managers have, like I said, in terms of their experience, their qualifications, the teams that they command, um, when they buy and sell stocks inside a mutual fund, you don't pay any tax because a mutual fund is a trust and they do not pay any tax. Until you redeem your mutual fund units, you don't pay any tax either. Whereas when you do that same buying and selling in your uh, trading account, then you have to pay capital gains tax on all of the profits that you book. If you do F&O, then you end up paying in tax at your slab rate as income from business. So it's very tax efficient to invest from mutual fund. Then there is the dividend advantage. So when you get a dividend on your stock, the dividend, you are taxed at your slab rate, right? If you're in the 20% slab, then you have to pay 20%. If you're in 30% slab, you have to pay 30% tax. When the same dividend comes into a mutual fund, the mutual fund does not pay any tax and you do not pay any tax until you redeem your units from the mutual fund. And when you do redeem your units, if you've held for more than 1 year, then you just pay 10% long-term capital gains. And even that has exemptions like we just saw with this section 54F. So there's a lot of inbuilt tax advantages to mutual funds. That dividend, by the way, when it comes into the fund, it adds to the NAV. So it's not like the fund is taking it home and parting with it. You as the investor, you're getting the benefit. Then there's a long-running debate about active or passive funds. Does any of you want to take an attempt at what is an active fund and versus a passive fund? Anyone want to take a stab at it? Feel free to Google. All right. So an active fund is a mutual fund which is actively run by a fund manager. Fund manager takes decisions on which stocks to buy, which stock to sell. A passive fund just tracks an index, like the Nifty, like we saw in this slide over here about what kind of returns the Nifty has given. So an index fund, like the one I've mentioned here, the Nippon India ETF, that will track the Nifty, and that's a passive fund. So the advantage of a passive fund is that you don't have to deal with a fund manager taking the wrong decisions and underperforming the market. Whereas the disadvantage of a passive fund is that by definition, you can't outperform the market, right? All you will get is the market return. The Nifty return is what you will get minus some tracking error, minus some expense ratio. This tends to be very small. So roughly you will get the index, the market return. So which one do you choose? Now, there is no clear-cut answer to this. Passive funds are extremely cheap. The expense ratios on them are very, very low. Active funds, by contrast, have a much higher expense ratio, much higher fund management fee. The other problem with active funds is consistency. So you'll have one fund doing well, let's say this year or next couple of years, and then it sinks and some other fund does well. And then you're like, why did I buy the first fund? So you don't want to get into that situation. So consistency is an issue. With a passive fund, you don't have to worry again because it's just giving you the index, the market return. So does that mean you should go and buy a passive fund? So a good guide to this decision is something called the SPIVA report, the S&P Dow Jones uh, active versus indices report, which tells you how many active funds have beaten their index in different categories, like large cap, mid cap, small cap. And in large cap, something like 80% of active funds do not beat their index. So the case there is, I think, quite straightforward in favor of passive. With mid and small, it's 30 to 50%. So yeah, it's a bit of a mixed bag. So mid and small, the jury is out. For large, I think the case is well made in favor of passive funds. Okay, so I've just given you a very simple method, right, where you can build wealth over time if you hold stocks for long periods of time, right? When I've told you about how the Nifty has done over 5-year periods, it seems like a no-brainer, right? What can stop you from making just tons of from making tons of wealth? Um, and this is where these other factors come in. So number one is greed. And by the way, the financial system will cater to your greed massively. So you will have ads on social media, people claiming they made X or Y or Z returns, which are far in excess of the market. They're not always lying, but sometimes they fudge in the sense they'll tell you data or returns over short periods of time. And that is not good enough. You need somebody who can consistently make returns and whose returns are audited, externally audited, not somebody who can just make some vague statements on social media. A mutual fund has audited returns, right? They can't lie. The NAV is public. So apart from these guys on social media, you will have bank RMs, you might have insurance agents, you will have all kinds of people coming to you at different times of your life, trying to get you to be greedy, trying to get you to invest in risky stuff to get higher returns. Before you decide on these kind of pitches, just ask yourself, in fact, forget yourself, ask that person one question. How do you make your money, sir? Tell us how you make your money. And if that person is not able to clearly explain this to you, how much money they make, then that's a red flag. If they're not able to explain to you how they make their money, that's the red flag. Because in that case, usually you're the victim. Usually the money is being made at your expense and it's not being disclosed to you. So be extremely careful. In fact, do an experiment. Just next time you meet your bank, of course, all of you guys are young, so you might not have to. You might not have gone to a bank or might not have to go to a bank. Today's a very digital age. But if you do go to a bank, and if a relationship manager comes to you, just ask that person, how do you make your money, and see what answer you get. And that applies also to online folks, to influencers. So let me take a pause here and go into some detail about the issues with influencers. It's a very heated topic on social media. There is angry statements flying back and forth. There is accusations flying back and forth. But if you think back to what SEBI said, I think more than a month ago, right? SEBI released a consultation paper where they said that we will stop the regulated financial entities like brokers, like mutual funds, from paying the influencers, right? From funding the influencers. Why do they have this concern? So here are some issues with how influencers operate. Number one, probably the biggest issue is about disclosure of sponsorship, disclosure that they have taken money to put a particular post or a video. Some people do it, some people don't. And the problem is nobody's monitoring this. There is no body, no authority, nobody who is checking this. And so you just have to take that person's word for it. And that's not good enough. That is not good enough from a consumer point of view. There is a body called the Advertising Standards Council of India, or ASCI, which is supposed to monitor this, and they do. There are orders against influencers on the website of ASCI. So after the session, I invite you to go. Those of you who are active on social media, just go on the ASCI website, Google them, and read the orders. What is the problem? Problem is ASCI is an industry body. They can't enforce a single order. They can't put a single rupee of penalty on anyone. Totally toothless. So that is the number one problem with influencers. There is no regulation, nobody monitoring whether a particular video has been sponsored or not. The second issue is in terms of these brokerage affiliate links. So if often you'll hear influencers saying that link in description, link in description. A lot of these links are from brokers. When you open an account through one of those links, the broker gives a cut out of every single commission from your trades to the influencer. So then they have an incentive to create another video which incentivizes you to trade so that you will pay more commissions to the brokers and they will get cuts out of every single commission. That's not cool. That's not on, because it destroys somebody's financial future. Why am I saying this? Why am I being so radical, right? After all, broking is not illegal. I'm being radical because you have to ask yourself, how do brokers in today's India make money? The vast majority of them make money through futures and options trading, F&O trading. They do not make money through simple cash trading. You buy some stocks, you hold them for the long term. Your broker's not making money. They're not charging you for those trades, right? That model has been disrupted. They are charging you for F&O trade. And there's a SEBI study which shows that 90%, 89%, let's be precise here, 89% of traders lose money in F&O. That money comes at your expense. And this needs to really, this model of money extraction needs to be contained. It needs to be acted upon. And thankfully, SEBI is now on that course. Feel free to ask me anything that you like about influencers. If you follow any of them, if you have doubts, please, now is the time to ask.
Thank you, sir, for your insights. We have a couple of questions in the YouTube comment section. So the first question is, what happens if I have an SIP of rupees 20,000 per month and for some reason I fail to pay it only for a month? Then will the SIP stop?
Great question. So you can pause an SIP. There is an option called pause. There's an option called stop SIP also. Now it depends on how you're doing the SIP. If you're doing it through, let's say, a fintech app like Zerodha or Grow or one of those, the app itself will give you the option to stop or pause an SIP. If it doesn't, please call up, look it up. Like they would have procedure to do it. Like maybe you have to mail them, maybe you have to call them. Or you can directly go to an RTA. An RTA is a registrar and transfer agent, which maintains all these records. They do all the admin stuff for mutual funds. You can go to the RTA office and stop the SIP there directly by filling up a form, your nearest RTA office. It's good to do this if you know you can't meet that next installment, because you don't want a check to bounce. You don't want a payment to bounce that attracts bank charges. So just pause your SIP and resume it with the month that you can actually pay the SIP.
Thank you, sir, for this incredibly insightful answer. The next question which we have is, which stocks should we initially invest in?
I have no clue. So I don't write about stocks in my page. I write about personal finance. And my answer would be pretty much what I said in my presentation, that there are mutual fund managers who have all of this training, who have all of this staff, who have all of this computing power to answer exactly that question. You don't need to yourself buy stocks. If you want to, by all means, go ahead. There are good resources out there. You can do your own research and buy stocks. But just think about all of the tax advantages that come with investing in a mutual fund. Think about who you're competing against, and then make that decision.
Thank you, sir, for your thoughtful answer. The next question is, as you stated, an increase in the holding period of the Nifty 50 shows that there's greater likelihood of making returns. But don't you feel that revolving the money and trading in short-term contracts would reap more returns?
So as I said, the only scientific study on this, which was commissioned by SEBI, showed that 89% of traders do not make money, right? You might fall in the rest 11%, you never know. But why take the chances? Why take the chances? If you really want to do this, maybe try it with a very small amount of money. But it's a jungle out there. It's very easy to lose money. Be very, very careful. um, the system is geared against you. You're competing against the very best in the market. I know you might not be convinced because I'm saying it because this is an old man's or at least a middle-aged man's advice. But you will realize it after you yourself have done it. I've lost money in F&O. Sometimes you just have to go through that pain to realize what it's like.
Thank you, sir, for such a thoughtful answer.
All right. Shall I move to the next slide then? Okay. So let's talk about the remaining 2 points here. One is life complications. Life happens. We've laid out all these amazing plans a couple of slides ago when you make an SIP of 50,000 and you stay invested for 10 years and you get a crore. It sounds very good on paper. It sounds very good in Excel. But frankly, things will happen, right? You might lose your job. You might switch jobs. A lot of you will go abroad for education. I'll talk about that in a while. Then in families things can happen. A lot of our parents are aging. We have to take care of them, and there is fear. Right now we're in a very nice phase. We're in a bull market. There's so much money being made so easily, but there are also bear markets. There's 2008 when the market was down 50%, COVID when the market was down I think close to 50%. You sometimes have to just imagine what it's like. Maybe just close your eyes and simulate the thought. How would you react when your portfolio is down 50%? And you don't know if the market was recovered. I mean, in hindsight, we all know that the market went up. But in that moment of time, it's extremely hard. You feel the pain. You feel the pain. It's psychological. It's on paper, but my God, trying to sleep, when your portfolio is down 20, 50% is really hard. It's extremely hard. So you have to be prepared. You have to tune yourself to not react when something like that happens, not react in a hurry, and contain your own fear, fight against your own fear. Okay, so there are, apart from markets and investing, in fact, since we're ending the markets and investing part of this session here, feel free to ask what you would like to about that, because the next bit is about insurance. It's about retirement, it's about tax, right? Feel free to type your questions. Let me quickly go over insurance. So what kind of insurance should you be buying? Term insurance. Term insurance is the kind of insurance that pays your family when you pass away, but it doesn't have any maturity value. It doesn't pay anything if you survive. This might sound contradictory. This might sound counterintuitive. Why on earth would you want to buy that kind of policy? The answer is that kind of policy, term insurance, is extremely cheap. For a few thousand rupees, you can get a crores worth of life cover. The other kind of policy, which is called endowment, which has a maturity value, which is aggressively sold by banks, by LIC agents, by all kinds of agents, has a lot of commissions built into it. The insurance cover is tiny. It's like a fifth or a tenth of what term insurance will offer. And it's not a good investment because there are all kinds of charges loaded onto it. Most of you guys are too young to have dealt with insurance agents yet, but if you do so in the future, just be very careful. And as I said before, first thing to ask them is, how much money are you going to make? Give us that in writing. Health insurance. When you start working, typically most corporate employers will offer you health insurance. They will cover you into the corporate policy. But we change jobs. We change jobs all the time. It's not like our parents' generation where they stuck around with one company for life or for most of their lives. So when you change your job, you lose your job, your health insurance policy is done. And then you're at risk. You don't want that. So buy your own individual health insurance policy apart from your employer, alag se, and keep paying that premium. Keep it with you because the premiums are extremely cheap when you're young. So keep that active throughout your life and keep increasing it because medical expenses go up. Don't have a very small cover. It might not be sufficient for you 5-10 years down the line. And by the way, there are tax benefits for this as well. Now, retirement. This is a long time away for you guys, so I don't want to spend too much time on it. But when you start working, you will see these things pop up. you see your HR, getting you to fill the PF form. If you work in a big corporate, PF, by the way, is EPF. They never say the E for some reason. But EPF, or Employees Provident Fund, is a mandatory thing. By law, your employer has to deduct 12% of your basic salary and match it with 12% of their own. And every month they have to contribute. This sounds like a lot, right? 12%. But remember, it's 12% of the basic salary. So you will, when you start your first job, you will have something thrown at you called C2C, or cost to company. So cost to company has many components, and basic salary is just one component within C2C. So 12% is of that basic salary, not of C2C. Let's assume that your C2C is 1 lakh. Your PF will, your basic will generally be, let's say, 30, 40K. So your PF will be 12% of that 30 or 40K, not of the 1 lakh. Then there's something called Public Provident Fund. You might not even have heard of it. It's like a very Uncle Zamane ka thing, but it's a fantastic instrument that the government has created. So what is the Public Provident Fund? It is a fund that is run and managed by the government of India. So no chance of default. They declare the interest, which is currently 7.1%. The interest is totally tax-free. It has a 15-year, 15 saal ka. In fact, some of you might have PPFs maturing if your parents made them when you were young. And that maturity is also tax-free. So the only catch is that you can only put up to 1.5 lakhs a year into PPF. But again, the earlier that you started, the better, because it's lovely tax-free interest that you get. Even the banks can't match the PPF rate usually. NPS, National Pension System. So again, this might sound very boring and controversial. Some of you might have heard of this OPS, NPS controversy. Don't be swayed by it. That is for government employees. For the private sector, NPS is extremely good. It allows you to put your retirement money into equity in a tax efficient manner, sits and compounds. If you heard of something called 401k in the United States, it's a lot like that. That money sits and compounds. And when you turn 60, you can use some of it or all of it to buy a pension, and your retirement is secured, right? In India, we don't anymore, in the private sector, we don't have company pensions. You have to build your own savings, and the NPS is the best way of doing that, of getting a pension when you retire. Then there's something called old regime versus new regime. The government brought this in a couple of years ago, but they made it really attractive this year. When I say it, I mean the new regime. So what is the concept? The concept is that you give up a lot of your deductions, but you get taxed at lower rates in the new regime. So every year when you start working, your HR will send you an email in April saying which regime do you want, and you have to figure out. So this table that we have created is an excellent guide to figuring out which regime to go for. Basically, it all depends on how many deductions you are claiming. So to those of you who are familiar with tax law, there's something called Section 80C, which is 1.5 lakhs. On top of that, there is something called Section 80CCD 1B, which is NPS, 50,000 rupees, right? So 2 lakh worth of deduction. Then there is house rent allowance, or HRA. Then there is medical insurance, Section 80D, where you can up to 25,000 you can get. So if all of that, if you add up, let's say that your salary is, you get a good job, start off with, and your salary is more than 15.5 lakhs. All of your deductions, if they exceed this 4.25 lakhs, then you're better off in the old regime. If they are below this 4.25 lakhs, then you're better off in the new regime. This is a rule of thumb. There are always other things to consider. You might already have a PPF running that your parents have created that you can't just give up like that. So you have to look at this in the context of your broader circumstances, but this is a nice rule of thumb. And Google this story when you need to choose old regime versus new regime, Mint article. And if you can't find it, just WhatsApp me, tweet me, LinkedIn me, any of those social media, I'll help you out. All right, so I'm sure this is relevant to a lot of you. You might be considering going abroad for masters or PhDs or whatever other kind of professional qualification. So think about the money have that discussion with your parents. Your parents are going to be paying for this. Of course, if you get scholarships, if you get grants, fantastic. But invariably, your parents will foot at least some of the bill. So you have to really figure out whether you're going to get a job abroad, whether you're going to get an employment visa. Countries change their employment rules all the time. Right now, there's a lot of demand. A lot of people are moving abroad, but these phases come and go. After the recession of 2008, most of the Western economies, they shut down a lot of these visa programs. So, and then recently they have again made it a little bit more attractive than it used to be. But this comes and goes. So just try and do the math to the extent you can. Don't just do it because somebody else is doing it or because it's cool, because you want to experience it. Um, or even if you want to do that, even if you want to just go abroad, study, and come back, or if you want to go abroad, study, work for a few years and come back, that's fine. I get it. But it is a costly affair. Your parents will be footing that bill. So don't just leave it to them. Talk to them, engage them, right? At least you will understand what the cost is of all of this. So let me talk about something the government has brought in from 1st of October, it's 2 days ago. Tax collected at source. When your parents pay your school fees, they will be hit by this thing called tax collected at source, TCS. Now, TCS is not a tax, it's just a collection of tax. So at the end of the year, when they file their returns, they can adjust the TCS against whatever tax they have to pay anyway. So let's assume that your parents' salary, your dad's salary is 20 lakhs, and he has to pay a tax of 3 lakhs. And because of this TCS, let's say 1 lakh has already been deducted while making the payment of fees for your education. That 1 lakh becomes, you can set it off, or rather your father can set it off against the tax that anyway was due. So it's not a big scary thing, but when you go to pay the fees, this will come. The bank will deduct this money, and suddenly you will realize, where did that money go? So so it is lower for education related remittances. This is 5%, it's not 20%. And if you're getting a loan, then it's even lower, it's 0.5%. But still, you need to be aware that this thing exists. And you also get this lower TCS for ancillary expenses like accommodation or living costs. But you have to have proof. So make sure you keep a record of your hostel receipts or your flat rent payment or your food. If you signed up for a mess, just keep all that so that the bank doesn't deduct this 20%. They deduct, let's say, either 5 or they deduct 0.5%, depending on whether it's a loan or whether your parents are paying for it. Any questions on this? Or anything else I've discussed so far before I move to the last slide?
Thank you, sir. We have a few questions here. So, sir, what must be the proportion of SIP to stocks?
There is no hard and fast rule. So like I said, stocks is a much more risky thing. You're basically saying that, hey, I can do a better job than a professional fund manager. So you got to be really careful. Ideally, an SIP is a less risky way of approaching this whole thing because you're giving your money to a professional and you're giving it in stages. So let's say that today is a peak, right? Let's say today is the end of this bull market. If you do a lump sum investment today, then suddenly you will find you've lost 5, 10%, 20%. If you do an SIP, because it's an average thing over a long period of time, you will probably not lose that much money, right? Because when the market falls, you'll again invest some money. It falls further, you'll again invest some money. It'll automatically happen because SIP will come every month. So there is no answer to that question, unfortunately. But broadly speaking, just be very careful about direct stock investment versus doing an SIP where it's a professionally managed thing.
Thank you, sir, for your insights. Regarding the equity, which is only for a long-term perspective, what returns do you expect in long run from Indian markets when its index rate is already growing at 18% CAGR?
Yeah, so 18% over what period, right? The robust scientific way of figuring out what percent it has given is the rolling return method, which I pointed out in this slide up here. Because the market is, we are at the middle of a bull market, right? Already things have, market has done extremely well. If we look back at the past 3 years or 5 years, it's going to be biased. We're going to see a very rosy picture. We don't want that. We want to look at different 5-year periods, right? What if you graduated in 2018 or 17 or 14 or 12, whatever? I mean, right? You want the chances, the probability of making money at any point of time. So don't look at 18%. Look at this method. Look at rolling returns, and that gives you a more realistic 11.73. That's about 12%. This is the long-term average of the Nifty. Will this happen in the future? There is no guarantee. There is no way of confirming that. But this tells you that if you buy and hold for long periods, chances are that you might get something close to this. The other way of estimating what you might get in the future, like I said, is to just look at the nominal rate of India's GDP growth. Again, this is an estimation because how do you know what the nominal rate of India's GDP growth will be? But this is an estimation where you can't go too wrong, right? If you say there is India's GDP will grow at 5% and inflation will be 5%, 10% is very conservative. Like it's really hard to go wrong with that kind of conservative estimate. So there are no firm answers in stock markets. Anyone who tells you there's a firm answer is lying. But there are ways to estimate this. And the more scientific you are, the more conservative you are, the less likely you are to lose money.
Thank you, sir, for this inspiring answer. The next question is, how can I save both immediate and long-term financial objectives, such a home purchase or a comfortable retirement?
Yeah, so equity is a great asset for long-term goals like home purchase, like retirement. And there are tax benefits to it, right? Currently, the long-term capital gains tax on equity is just 10%. If we were to estimate that the market will give us a 12% return, and let's say you want to use that money to buy a home, then you take the benefit of Section 54F. Oops. Yeah, Section 54F, so that even that 10% goes away. And if your 50,000 SIP per month grows at 12% over 10 years, you get your 1 crore, right? You get your house. This is not the only way of doing it. You can, maybe save 50 lakhs from SIP, take a loan for the other 50 lakhs, borrow from your parents for another 20 lakhs. There are so many permutations and combinations. But someone who's starting from scratch who doesn't want to take a loan, equity is a great way of achieving this goal. Same for retirement. The exact same logic applies to retirement. There is no 54F there, but there is a fantastic NPS system. NPS has its own separate tax deductions. Your money will compound over time.
Thank you, sir, for this truly informative answer. So the next question is, are student loans a good idea if I want to study abroad?
Yes, fantastic. So let me get that last slide, which is about education loans. So here's the deal, right? Psychologically, it's scary. You have a loan on your shoulders before you've earned the first rupee from your paycheck. You really want that. I get it. I get how scary that can be. But from your parents' point of view, actually, it might save some money. It might save some tax. So don't think of it as your shoulders. Like, as long as your parents are anyway willing to pay that money to you for your education, and they're willing to stand as guarantors for the education loan, this can actually save them some tax, because under Section 80E, the interest on the education loan is tax deductible, and it can go up to 8 years. So if you're able to convince them and it works out for them, then education loan is great. If you are confident of your prospects after your degree, again, education loan is great. But just be very clear on why you're getting this loan. There are good reasons for it, and there are bad reasons. A bad reason could be you take a massive loan, you have no backing, your parents can't afford it really, and you just wager on the fact that your degree will lead to a fantastic job and you'll pay it off. That's a very scary proposition.
Oh, thank you so much, sir, for this educational answer. The next question is, should I prioritize in savings or investing?
So the only difference between savings and investing is that savings normally goes into a bank account or a bank FD. You get, let's say, 5, 6, 7%. All of that is taxable. Of course, you don't take a risk there. Your banks in India very rarely fail, and anyway, there's a 5 lakh deposit guarantee. But at a young age, I mean, if you just wait to invest, if you don't, you're giving up on the power of long-term compounding. The later you start, the more money you have to put aside for the stock market, for our economy to work its magic.
Thank you, sir. Now we have a question from a YouTube chat section. So why should one go for a large capital mutual fund even after charging higher expense ratios? Fund houses are failing to beat their benchmark.
Yes. So if you are convinced of that, and this goes back to the active versus passive debate that I covered here, active versus passive. So if you think that most mutual funds are not beating their benchmarks, and actually I spoke about this, right? In the large cap space, as per the SPIVA report, 80% are not. So that's where passive funds come in, right? Index funds, fantastic, low cost. They will give you your index return. You don't have to deal with the fund manager underperform the index. The wrong way to think about this is because the expenses are high, they're not beating the benchmark. So, hey, let me just try this on my own. Because at least they have, like I said, professional qualifications, experience, training, computing power teams. You have nothing. You might have some research of your own, but the odds are stacked against you.
Thank you so much, sir, for your enlightening response.
Great. Okay. So we are at the end of the presentation. Happy to take more questions. Hope that this was informative. Hope that not too many people fell asleep. And hope that you guys do extremely well in your careers and in your investing lives. I'm so glad you guys took this initiative. A lot of us, in my cohort, we just walked into the job market with no knowledge about any of this stuff. So really glad. It's a privilege to be here. Any final questions, or shall we conclude?
So we have a question. Do we get exemption in cash from exemption in tax from home loans?
Yes, you do. So there's something called Section 24B, which gives you an exemption for home loan interest, which is over and above the exemption for principal repayment, right? Loan has two components: principal repayment, interest payment. Principal payment has a tax deduction under Section 80C, but 80C has a lot of other things also. It has ALSS funds, it has insurance, it has PPF, it has NPS, it has a bunch of things. So your home loan there is competing with so much else. 24B is only for interest. That is up to 2 lakhs if you are living in that house, if it's a self-occupied house. If you're renting it out, there is no cap. There is no cap on how much reduction you can get. There is an indirect cap because let's say you make a loss on the house, then the maximum loss you can claim is 2 lakhs. Let me explain how you can make a loss on a house. So let's say that you get interest rental income of 5 lakhs and your interest bill is 7 lakhs, right? Technically, you're making a loss. Your rental income is not covering the interest payment, but that's capped at 2 lakhs. So yes, you do. There are a whole bunch of tax benefits thrown at real estate, and that includes home loans. In fact, we did a story on it quite recently. So answer is yes.
Thank you, sir. So the next question is, what are your thoughts on using technical analysis and charts and giving them more weightage over fundamental analysis of stock?
Okay, so I have a very controversial answer. Not many people agree with me in this because many people practice technical analysis. I don't think it works, right? I don't think it works because I haven't seen successful examples of people applying it in their investing. The big investors that we do know, Warren Buffett, Rakesh Jhunjhunwala, they might have used a bit of it in their trading, but I don't think that their fortunes have been built on TA. TA is about trading, and especially if it's applied in the short term, right? In the long term, the charts might support a thesis of fundamental analysis, which is fine, right? It's just it's playing an ancillary role. You're not basing your decision on it. You're using it to substantiate what you anyway figured out from a company's balance sheet or a P&L statement. But in the short term, the charts are so open to interpretation. People have so many different, it gets crazy complicated. So I don't really think it's a sustainable way to make money. It's very attractive. It's seductive because you see a chart within 5 seconds, you realize buy or sell, you're done. Go home and have tea, and then in an hour you made a profit or loss. It's like high adrenaline, high pitched kind of thing. But that's not sustainable. That's not how you make money. Just go one step down, right? How do companies make money? Do they make money every hour? Do things, fundamentals change every hour? Answer is no. It takes quarters and years for a successful product to get launched, to come out, to be ingrained in the market. How long did Apple take? How long did Alphabet take? How long did today's big companies, Reliance Industries, right? It's been decades. You can't possibly predict what will happen tomorrow, what will happen next week, what will happen next month. You can't. It's too seductive. It's too appealing. I think it's extremely risky. It's a recipe for, and you guys are not gonna like this answer because I'm just being very boring here when I'm saying that do an SIP in a mutual fund. It's not the thing. I mean, when I was doing F&O trading, I tried to apply F&O to apply technical analysis. So I've been through it. I've been there, done that. If you really want to practice it, like I said, apply to a very small part of your money. See how it works out, right? See how it works for you. And if you see that it's not working out, pull the plug. Pull the plug.
Thank you so much, sir, for sharing your expertise. Now we would like to move to the closing ceremony.
As we bring this brilliant speaker session to a close, we firmly believe that the learnings today will hold our attendees in a good position for the future. Today, Mr. Neil Borate has embodied the core principles of life, serving as a profound source of inspiration and driving force behind our pursuit of dreams through diligent effort. On behalf of St. Xavier's College Autonomous Kolkata's Entrepreneurship Development Cell, we extend our sincere appreciation to Mr. Borate for generously imparting his extensive wisdom and expertise. It is an immense honor and privilege to have had the chance to host such a highly regarded individual. Sir's willingness to take time out of his busy schedule to engage with our audience is a reflection of his commitment to nurturing the entrepreneurship spirit in the next generation. A special mention to our respected principal, Reverend Dr. Father Dominic Savio SJ, and Vice Principals, Reverend Dr. Father Joseph Kulindai SJ, Reverend Dr. Father Peter Arukyam SJ, and Professor Bertram da Silva for encouraging us to pursue greatness and live up to the great Xaverian reputation. I also thank our faculty advisor, Dr. Arup Kumar Mitra, for his leading supervision and support at every step. We sincerely acknowledge our attendees for being patient, interactive, and putting forth such compelling questions. Lastly, I want to express my profound gratitude to the members of the Entrepreneurship Development Cell for the invaluable support, timely execution, and expert guidance. It is thanks to your effort that our session has achieved success. Attendees, the short link to access both the credit sheet and quiz form will be shared in the YouTube chat box. So kindly fill the sheet to avail the 4 hours of non-academic credit. For the interested in receiving e-certificates, please make sure to complete the quiz within 15 minutes. Once more, I extend my heartfelt thanks to all those who joined with us today, wishing you all a wonderful day ahead.
Thank you so much, Vanshika. Thanks, everyone. It's a privilege to be here.